despite the average inter-year drops of around 14.2% if you go all the way back to 1980. The annual returns, the actual annual returns, were positive 35 out of 46 years.
Welcome back to another episode of Off the Ball. Markets are moving fast, and as always, we're here to help you stay one step ahead. So I'm Nate Tonsager, joined by Monument's founder and CEO, Dave. Dave, how are you?
I'm good. Listen, I'm just going to start it off right now. We're talking about SpaceX today, right? Because our episode from June 10th, where we talked about SpaceX a lot, it was all over the news and everything. And here's a quote. Here's what I said. Here's my prediction. I suspect sometime over the next 6 months, SpaceX will be trading below its initial offering price. That's a guess. I have nothing but my caveman brain influencing my thought on that. Okay, so that was me back in June 10th. Caveman brain at all. But now let's just insert the clip so everybody can see it. People who are buying SpaceX are not getting in early. Okay, this is an exit strategy for the venture capitalists who bought into SpaceX years ago at a fraction of what the general public is being asked to buy it for at the initial trading. The 6-month window hasn't even come close to opening up on my statement yet. So I'm not up here declaring anything, and I'm certainly not doing a victory lap. But here's the thing, I called it a guess when I said it, and it was a guess. What wasn't a guess was the data underneath it. So IPOs have a history, and that history isn't kind to the people that start chasing them on day one. So later in today's episode, we're going to be checking in on where things stand. I mean, not to keep score, but because what's happened so far says something useful about the next time everybody at the barbecue is talking about the thing you're missing out on, because that's coming. Some other AI company is going to come public, and it's going to be a big thing again. And I'll end it with a quote that I had from the same episode, which was, quote, people who are buying SpaceX are not getting in early, and that the IPO is an exit strategy for venture capitalists. And we're going to talk more details on that a little later in the episode.
Oh yeah, I tried to put a moratorium on it because I never like taking, again, not a victory lap, but making a call about something that's only been around for a month. But hey,
right.
We put the kibosh on it. We have to talk SpaceX today. So
yeah.
It's, as always, on our AMA episodes, our Ask Monument Anything episodes, we're diving into kind of 3 topics that listeners, clients are really asking about, and trying to focus on maybe what Wall Street is really kind of missing about those topics. So just so everyone's aware, we're recording this on July 23rd. Again, markets are moving fast, so things can change, but I think the topics we have are pretty evergreen in certain ways, especially for the current market. And today, we're going to be talking about alternatives and private market investing and the craze around those kind of asset classes. We're going to talk about the AI market, and I'm putting this word in quotes, bubble. And then finally, we got to do an update on SpaceX. Dave, I know you kind of gave the preamble there, but I think those will be the big 3 that we're going to talk about today. So
yeah, because I think there's lessons there. It's not, the SpaceX thing isn't like a told you so or nanny boo boo or any of that sort of stuff. It's like, hey, listen, you've got to understand what happens with these things, and there's history on it, and we just want to use it as a good learning point with current events.
Yeah, it's interesting to talk about too. To your point, again, it is. So I always like to give you the floor. Yeah, where do you want to start?
Yeah, I just talked about SpaceX. So let's not talk about SpaceX. Okay. Let's start with the AI market bubble. What do you think about that?
Yeah, I think the question that we got is AI bubble is market talk is on the rise, whether it's in the media, whether it's, you're reading it online. What should investors be doing about it? I'm here to tell you there is no bubble, in my opinion. There is no bubble. Bubbles happen when there is irrational exuberance and excess risk-taking. That's not happening. I think a lot of people are so focused on just, again, the fear emotion that comes with this word bubble, that they're being kind of sold the story that the data isn't really showing is there. And I think there's kind of 3 big things that I would look at for the bubble. I mean, the first one is, again, excess risk-taking. It really happens when consumers are irrationally exuberant and so excited about everything. And there is a lot of excitement about AI, but consumer sentiment, as measured by the University of Michigan, one of the big surveys out there, is actually down year over year. consumers are less enthusiastic about the economy than they were a year ago. Not incredibly negative, but they're not as optimistic as they were. So when you couple that with kind of, can a bubble form if consumers aren't really feeling that irrational exuberance? The answer is no. Point number 2 is, yes, semiconductor stocks were on a rocket ship. Again, SpaceX, might as well use that fun pun there. They were on a rocket ship for a long time. And really this year specifically, at one point, the SOXX ETF, the semiconductor ETF, was up almost, I think, 70% at some points. Well, since then, it's down 15, 20% from its recent high. A lot of the air has come out of those companies. A 20% decline is classified as a bear market. So you're seeing a bear market occurring in the semiconductor stocks.
Right.
Plus the Mag 7, which we always talk about, your NVIDIAs, your big companies, Amazons, Microsofts, all those are actually lagging the market this year. Not to mention, when we talk about IPOs, there's 2 big ones in the pipeline coming up in the near future with OpenAI, who has ChatGPT and other kind of AI products, and Anthropic, who has Claude. Both of them were saying, we're going to IPO real shortly after SpaceX. We're working on it. Most of them are now, or both of them are really talking about now delaying it till 2027. And that means they're not as optimistic about launching into the market because they want that craze. They want the support that SpaceX had.
Right.
So you have semiconductor stocks, which had been, I guess, people's biggest fear of a bubble. The air's come out of it, and you're not seeing irrational risk taking or consumer sentiment, rising through the roof. And I think the other thing I keep hearing is that there's a bubble in the market because this one sector is doing so well. This one industry is doing so well. Well, it is doing really well, but I think it's really important to look at, the earnings of not just those companies, but the market itself. If you look at where we're just at the end, we're getting some Q2 earnings reports now, analysts expect the Mag 7 companies to grow their earnings by 30%, 31%, while the other 493 companies in the S&P 500 are expected to increase earnings by 22%. So sure, there's a few companies that are really driving some earnings growth, but that doesn't mean the rest of the market isn't growing. Think about that. 493 companies are expected to increase earnings again, on average, when you average it all, 22%. And then I think another one that I really like is you look at Micron and NVIDIA are some of the highest earning companies in the S&P 500. Because again, directly tied to chips, AI companies. If you take out those 2 companies from the S&P 500, what happens to earnings? I keep hearing from listeners, from investors, of earnings are only in these kind of companies. Well, okay, the S&P 500, all 500 companies, 24 or 25% growth when you include them all together. If you take out those 2, it drops to 16%. So yes, it goes down, definitely. But it's not the end of the world. So how can you have a bubble when there are cautious consumers, strong earnings across the market, and positive earnings, and you're seeing the air come out of these semiconductors names in the market rotating?
Right.
I just don't see where the bubble is.
Well, I think people are looking at the performance of some of the stocks that are in the top 10 of the S&P 500 right now and comparing them historically back over how much those top 10 stocks in the S&P 500 contributed and what their market cap was. And I think the news is bringing this to people's attention, and it can look alarming, right? But to your point, when you talk about a bubble or not, I love the data about the equal weight. And I think that with those earnings expectations of the Mag 7, I'm just going to call them that, but there's more than that. I'm actually talking about the 10 largest market cap weighted stocks in the S&P 500. But when you look at those, it's easy to get concerned about them because they have such an outweighting relative to history. So with second quarter earnings coming up, and I'm just going to say that 31% number of earnings growth, right? If you're in one of the top 10 stocks in the S&P 500, that is attached, however, coincidentally to the AI market and all of the buzz. and the earnings only come in at 30.5%, you're going to see a massive sell-off, right? Like, I have not dug in on what's going on with Tesla today, but today, the 23rd of July, Tesla's down like 15% today. So there must have been some earnings or something. Again, I don't know what it was, and people listening to this will know the answer to that question, but recording right now, I'm just looking at it. But if you go back and you look at, if you go back decades and compare the top 10 holdings in the S&P 500 to where we are today now, in 2015, the 10 largest market cap stocks in the S&P 500 were Chevron, JP Morgan, Procter & Gamble, GE, Wells Fargo, Berkshire Hathaway, J&J, Microsoft, Exxon, and Apple. Okay. And those 10 stocks were a $3.2 trillion market cap, all added up together. By the end of 25, so a decade later, that 3.2 trillion, the top 10 stocks now represent 19.4 trillion. And those top 10 stocks are 39% of the index total. And those stocks are JP Morgan, or at the end of 25, JP Morgan, Berkshire, Broadcom, Tesla, Meta, Alphabet, Amazon, Microsoft, Nvidia, Apple. That's a big difference from Chevron, JP Morgan, PG, General Electric, Wells Fargo, J&J. And now, halfway into 26, we've had two additions into that top 10, which is Eli Lilly and Micron, which you talked about. So I think people feel like there's a bubble because they're so tuned into these 10 biggest stocks because they're in the news all the time. It's where individual investors are having the FOMO and getting in there. And so I feel like there's a concentration issue going on in people's portfolios. And then there's a concentration of information and what's being talked about in the financial news media that probably drive people to feel like there is a bubble. By the way, interestingly, back in 1985, here are the top 10 stocks in the S&P 500. And I'm going to come back. I'm using this as a point to come back to your point, Nate, which is these were DuPont, Kodak, Royal Dutch, Amoco, Shell Oil, AT&T, General Motors, General Electric, Exxon, and IBM. None of them are in there now.
No. The market rotates.
Right. And so that's why you may feel, so now Nate, I'm coming back to agreeing with you, right? I think I agree with you, but I think the people's perspective is that we've gone from a $300 billion market cap of the top 10 stocks in 1985 to a $24.5 trillion market cap in July of 26. And so just like emotionally and visually, I think people are like, this seems very lofty. And yeah, I know it seems very lofty, but when the market cap was 3 billion and it went to 2.4 trillion, that seems lofty too. Right? When you go from 2.4 trillion to 19.4 trillion, that seems very lofty too. And there's going to be moments in those decades of reporting on the S&P 500 that you will see 20, 30, and sometimes even 40% drawdowns in the market. I think the lesson here is, hey, you've got to be aware of what you're invested in, even if it's synthetically through the S&P 500, because if you own the S&P 500, 38%, if you just own that one ticker, 38% of your net worth is tied up in the performance of those 10 stocks. And those 10 stocks look like they have gotten a little lofty in their valuations. And I think that's what makes people worried.
Yeah, I think the effort in investing is feeling, feeling. Like it just really causes so much problem. And I think the more that investors rely on, again, that F word of investing, is they make bad decisions. Because while if you're just buying and holding the S&P 500, you're going to go with wherever those 10 companies are going to go because of how concentrated it is right now. Now, over time, as those come down maybe in price and that air comes out of that concentration, you're going to start owning other parts of the market, but you got to be able to ride that ride. Why not, again, have a strategy that is looking at which parts of the market are doing better? Like,
right.
All this AI bubble talk isn't about, should I be reducing my stock exposure? Your stock exposure should be set by your long-term allocation and your goals. What you should be looking at is what types of stocks am I owning? Because 66% of stocks that are listed on the New York Stock Exchange are making new highs right now. 2/3.
Yeah.
You're not hearing that number. You're hearing about all this volatility and all this, oh, well, this stock is going down, like the Mag 7 names are doing this. Again, you got to know what you own and then have a strategy to navigate around these kind of swings because they're so normal, like you said.
They are normal. And I'll tell you a great chart. One of my favorite charts in the world comes out of the JP Morgan Guide to the Market, where they talk about the S&P 500 intra-year declines versus the calendar year returns. And essentially what that chart shows people who can't or listening and can't see it, which is, hey, the S&P 500, what did it return on December 31st at the end of every calendar year? What was its return? Okay. And over the course of that calendar year, what was the decline in the S&P 500 for that calendar year? Okay.
Yeah.
So since 2015, we've had 3 down markets at the end of the calendar year. Okay. A -1% return, a -6% return, and then a 20%. I'm sorry. And then a -19% return in 2022. Okay, so 3 out of the 10 years had calendar year declines. However, if I go back and I'm just going to rattle these intra-year declines on each one of the calendar years. There was starting in 2015 was down 12%, 16 down 11, 17 down 3, 18, which is the -6% return, down 20%. Interestingly, the next year was up 30%, but the market had an inter-year decline of 7%, so that wasn't really that painful. But then you go out to 2020, and this is COVID, of course, but you had a -34% intra-year decline when the market finished up on December 31st of 16%. And then you have a -5% decline, a -25% decline. That was 22. And then 23, we had a 10% decline, 24 and 8. And then in 25, a -19% intra-year decline. But 7 of those 10 years had calendar year positive returns. So despite the average inter-year drops of around 14.2%, if you go all the way back to 1980, the annual returns, the actual annual returns, were positive 35 out of 46 years. So that goes back to your point, Nate, of like, hey, listen, feelings are one thing, but your statistical probability of making money is in your favor in such a positive way by just staying invested and riding these things out and really managing your cash position so you're not calling up in December of 2022. I'm sorry, in the middle of the year of 2022 and saying, "Hey, I need money when my portfolio is down 25%." Like you want to avoid that. And if you can avoid that, the odds are in your favor. And if listeners are the kind of people who like to go to Vegas and play craps and everything else for your 49, 48% chance of winning, and you're I'm telling you, the equity market is probably the best gambling, if you want to call it that. I'm using my air quotes, but like the highest probability of making money by a long shot. Yeah. So I think that just goes back to your point about like, you can be aware of things, but man, the odds and the statistics are in the favor of the long-term stay invested investor who's smart about when they need money. End of rant.
Totally. No, not even a rant. It's just quality. It's a quality principle of investing. Yeah. So, all right, we've waited long enough, Dave. All right, second question. I'm going to give it to you.
Okay.
How has SpaceX stock been doing since the IPO?
Not good. Oh, but you want me to say more? Okay.
I mean, we could leave it at that, but I feel like there's more behind it.
Well, of course there is. So I don't know what SpaceX is doing today.
Down 2%, around 112.50.
112.
Let's call it.
Right. Okay. So it went public at 135, right? Okay. So here's the thing that concerns me about SpaceX minus what I've already said about it, right? Because, I just said, look, back in our June episode, my point was that I think if you're interested in owning SpaceX, because these are two different things. Interest in owning SpaceX stock and interest in owning the IPO. Those are two totally different things, right?
Yeah.
So I'm talking about owning SpaceX stock. And what I said was, if you really want to own SpaceX stocks, I think that there will be a better opportunity for you to have an entry point than the IPO offering. and or any subsequent follow-on rally of that stock, which we've seen what happens. I mean, at one point it's trading over $200 a share. It's down now at 112. But here's my concern about SpaceX, the stock, even if you own it right now. Like, let's just say you went in and bought it for 112. You'd be like, man, I just got a discount. Okay. The reality is that 95% of that stock is still locked up. Okay. And that means there are a lot of shares that can't be sold yet. Now, there are some earnings results, I think, coming up the beginning of August, which are going to be telling, but I don't think their earnings are things that people should get excited about, because even if the earnings are blowout, okay, you still have all of these unlock periods. So if you think the pressure on the stock is bad now with only 5% of the float out there actively trading, you've got August 11th, which is when 20% of the remaining 95 gets unlocked. Then you've got September 24th, 14% gets unlocked. October 25th, 14% gets unlocked. And then on November 7th, the remaining 28% gets unlocked. So if you have seen this much price volatility on 5%, like, imagine what happens when all of these people who can't get out of it now can get out of it. And what are they going to do? And I just think that is a massive headwind on this stock. So if an investor is interested in SpaceX, the company, the stock, and what it does and can do in the future to generate earnings as a company, I think you end up with a much better price entry point after the final lockup in November. I'm willing to be wrong on that. I could be totally proven wrong on that. However, I just think that looking at data and how well IPOs do, if you really want to own that stock, you should be considering waiting until November 7th. That's kind of my thought on SpaceX.
The shares that are getting unlocked, they're being unlocked for early investors who, even at 112 a share, have made a ton of money. Mm-hmm. They've made a ton of money. If you bought it in the secondary market, you're really probably underwater at this point. Right. Or even you bought it at the IPO, you're underwater. So while you might be kind of diamond hands, right, is that old saying about holding on for it to eventually rebound, you got to realize the people that are going to be getting this see this as a huge liquidity event. And that's what we said in June. Right. This is kind of a liquidity event for a lot of people. And I think, to your point, I guess, moving on, and the earnings will be very interesting.
Yeah.
Because the preliminary documents that they had in the IPO show they are not a profitable company and they burn a lot of cash. Yeah. A lot of cash. And candidly, space, while it's a really interesting long-term play, it's a very volatile industry right now. Earlier, I think it was earlier this week or about a week ago, SpaceX had to delay a launch. And guess what happened to their stock on that day? Stock got hammered. Because again, it's just an industry in general that is, I think, very difficult long-term growth. And there's ways that you can kind of see, because SpaceX isn't the only company doing satellites, rocket technology, space exploration. There's actually a ticker for an ETF that you can go and get exposure to a big basket of these kind of style of companies. And funny enough, this is when the naming ticker, it actually really fits. It's ticker UFO. So well done them. That's good marketing. What's interesting is since the end of May, so before SpaceX went public, since the end of May through today, it's basically down 35%. Since the SpaceX IPO, it's down 17%. So you've seen significant declines across the entire space industry. But what you did see earlier in the year is at one point, ticker UFO was up 70%, 75%, because it was kind of breeding into what this hype was going to be around it. And just like the IPO, if you think about it, the price of UFO moved higher. And as the IPO kind of became and it unlocked shares, people started selling it. Because it's, again, space is a really important industry that could be profitable, but it is the wild, wild west out there where, I want a piece of it, but I think instead of buying the stock, I'm okay just getting exposure through passive index funds. So I know we just talked about you can get exposure to the top 10 companies, you're over-concentrated. SpaceX is going to be in a lot of these funds.
Yeah.
So I'd rather take that more passive exposure and know that if SpaceX goes to the moon or Mars, I guess, right? And the stock price shoots all the way up. I'm going to benefit from that, but I don't need to take the risk of being so exposed to a single name that is in this volatile an industry.
Well, that brings me to, okay, I'm getting a little off topic here, not wildly off topic, but I'm connecting this conversation to the previous conversation that we had with the bubble. But and I don't know this, but what is the ticker for the Mag 7 ETF? Because I want to know, if you have it up, I want to know how well it's performed year to date.
So the ticker is MAGS, MAGS.
Okay.
It is, as of right now, I'm seeing year to date performance down about 3% right now. Now, today's a bad day for the MAGS. So it was positive until today.
Right.
But again, up maybe 1% before intraday trading on the 23rd here.
Yeah. As of today, right now, in our ticker machine.
Old school.
It's with today's action, because it's down 5% just today. It's the Mag 7 ETF, MAGS, is down year to date 4.2%. Okay. But here are the underlying makeups of that. Apple up 18%, Nvidia up, I'm rounding, okay, up 12%, Google up 1.5%, Amazon 94 basis points, so a little under 1%. Then you've got Meta down 9%. Again, I'm rounding. Microsoft down 21%, and Tesla down 28% with a 13.5% down day to day, which is probably why MAGS is down 4% today. Okay. So you look at that and you just think like, okay, if you're really over concentrated in stocks in those MAG 7, you're probably down somewhere around 4% today in your portfolio. But that just goes to show you, like, the Mag 7 is not a diversified portfolio, right? Yeah. And so if you are heavily concentrated in the MAGs because FOMO or whatever, like your performance relative to the S&P 500 is pretty bad this year, because the S&P 500 is up, I'm going to come round again, like 8.5%. Okay. And frankly, the QQQ ETF is up almost 13% year to date. So I just come back to, okay, I get it. There are investors out there who want the Mag 7 and whatever, but I don't know.
Whatever it is, yep.
Right. And so personally, I don't think that the average investor should be trying to concentrate their risk to juice their returns, because at some point in the future, you said, and I'll tell you something else. Okay. When you look at these AI stocks specifically, okay, and people say like, oh, Nvidia, like no one out there is really like using Nvidia products. I think there's some Nvidia like products in desktop computers and stuff like that, right? But there's so much of these Mag 7s, they're just not really consumer products that people are using. So they've got their own sort of economy going on with this. So, back to your point, like, hey, things can be doing really well in the economy or in the stock market and have a totally different situation in the Mag 7.
Yeah.
Anyway,
and I think, and it gets into, I think you said it there, there's almost this desire of FOMO. And I think SpaceX really shows that desire of the FOMO. And again, with the Mag 7s, we've seen that for years now. It's again, people thought it, and again, I don't want to poo-poo it too much because it's going to be around for a while. And I do think, here's my prediction, is SpaceX and Tesla are going to become a single company. Like, Tesla's at down, would you say 20 some percent and down big today? Like,
yeah.
Tesla's a struggling business. SpaceX has got all the hype right now. It kind of makes a lot of sense to make them a singular Musk company. I put that word in quotes, but yeah, I mean, I think it's FOMO. It is FOMO. It's that F word of investing again. It's, I guess that's the other F word of investing, FOMO and feeling, avoid those at all if you can. They don't lead to smart investment decisions. Yeah,
exactly. Because if you look at, and again, this is another JP Morgan chart, but if you look at the range of stock market returns over one, and then a 5-year rolling, a 10-year rolling, and a 20-year rolling, you get out to the 10-year rolling, and that you only have a 1% chance of having lost money over 10-year rolling period, and over a 20-year rolling period, the worst performing equity you'd be up 6%. Annual average return. So an average annual return of 6% over 20 years. And it could be as good as 18. I mean, there's a deviation in there.
Yeah, sure.
But man, anyway, It's not as hard as what everybody thinks.
No, but all right, Dave, last but not least, I think the final question for today is around the craze that I keep hearing around private markets and alternative investments. And I think the important question to answer is, why are investors so obsessed with these asset classes? And how can they actually invest in them?
Okay. So I think the craze is a function of the asset management companies having a lack of interest from the institutional market where they normally sell their private investments, and are trying to make up for that by getting the retail individual investors invested in private equity, whatever you want to call it, alternative investments. So they see it as a need to continue to generate fees in the absence of institutional interest in it. And they're being marketed to, and they're being shown sexy graphics and things like that. However, okay, so that's where I think the craze is coming from. It is awareness and, hey, take a look at this from a marketing perspective that they've never been exposed to before in the past. And this is the whole sales cycle of Wall Street. And you and I have talked about the private equity before in other episodes. But I'm just going to share with you, Nate, and everyone listening, a personal experience that I have with private equity that I think kind of sums it all up really, really well. So I am admittedly a small investor in a venture capital fund that was owned by a friend of mine, and I wanted to support him in getting his funds up and going. And so I did it. And that was maybe a 2019, 2020 investment. So I'm kind of coming up on the 7-year, J curve return window, if you will. Okay.
And I think that's important to call out is so that's really what it is. Most of the time you put money into the private investment and you don't see really the benefit of it for at least 7 years. So that's where, again, that 7 years is kind of like that industry normal where you get kind of your returns.
Right. So for 7 years, I've been paying a management fee, a stiff management fee on assets that I have not had any return on whatsoever since I put the money into the fund. Now, there are probably some paper gains in there, okay? But I'm just gonna make up an example. Let's say I put $100,000 into it, okay? So what I did with that $100,000 was I had to forego the returns that I would have seen in the public equity markets where I would have normally invested, let's just say the S&P 500. So I get an email the other day saying like, hey, great news. We're going to have our first distribution back to you. We are returning 20% of your capital. As if that is the most incredible news I could have been given that week, that I'm getting 20% of my money back that I put in 2019. Meanwhile, okay, I missed out on a 30% return in 2019 in the S&P 500. I missed out on a 16% return in 2020. I missed out on a 27% return in 2021. But I also missed out on a minus 19% return in 22. But then I missed out on a positive 24, a positive 23, a positive 16, and a positive 10% year to date.
Yeah.
So when people get excited about these private investments and they think they're going to get in on something early, like, look, that's my experience. I don't regret making the investment because there was more to the investment than just getting returns. So, there was that. I should disclose that there was, but I wanted to help a friend. But I look at it and I'm like, I get so tired of this private investment thing because this is what people experience when they get told, hey, you're going to get in on all these kind of things, blah, blah, blah. And then you experience this over 7 years. And I think to myself, what did I really get out of that? You could argue diversification. I would argue opportunity cost. So
I think
I'm just not a fan, especially with the fees,
Well, and I think, again, that's all the big risks are the illiquidity.
Right.
And usually they're high fee. They're also very complex. Again, you can get into things where we're not going to do the full breakdown, but the J curve is something you're going to hear from people, and you're going to hear about all this. And I get why people are excited to buy them. I really do. there's an allure there, like you talked
Yeah.
about, of I'm going to get in this company early and it's going to, go up and be the greatest investment ever. I'm going to get 1,000% return because I got in early. I mean, look at SpaceX. I mean, in theory, if you got in early, you're going to see a huge return as these lockups expire.
Right.
Now, I think the other thing that I keep hearing what people more and more, I think, are using as more of a point of why you should be invested in privates is private companies are staying private longer. Right now, it's about 14 years is the average from a company to go from initial launch all the way to its IPO. 14 years. 10 years ago in 2015, that was 10 years. That's 4 extra years of kind of growth that's happening in the private markets. And then the story comes of, well, shouldn't you want to tap into that? Like, do that. But that's a 14-year investment, Dave, to your point, where you're not able to access your funds. There's the opportunity cost of could you be in the public markets? And you got to take that risk. It's really a home run strikeout kind of investment class, which has just never been my style. I value batting average and hitting some doubles and being on base and getting on base, the money ball. It's the money ball investing style that has always been more appealing to me. That's why private investments, especially in the high growth space, because I think that's the other thing that goes maybe under discussed is so many people think alternative investments are just high growth investments.
Yeah.
I'd argue that's one bucket. The PE, the venture capital funds, private equity, whatever that is, that's a high growth play. You're trying to get really high returns knowing you could strike out.
Right.
But there's 2 other buckets I think people kind of can tap into in the right situation, but it's got to be really specific niche kind of use cases. And that's tax efficient income. If you need to generate income and you want to get into a private real estate fund where you can get the, income payments on a recurring basis and have, that's supported by the private investment in physical real estate. Okay, I can understand this case there, but you got to need the income and be okay still giving up the liquidity of your principal that you've invested. And 2, there is a benefit to having some diversification outside of stocks and bonds, and you can get that in the alternative space.
Yeah.
Historically, the correlations, so how things move against each other with infrastructure funds and farmland funds are different than stocks and bonds. So if you do want to add something that's not stocks, not bonds, you can look at alternative investments, but I don't think that makes sense for everyone. I think back to what we always say at Monument, cash planning. Cash planning is the best diversifier. It's the cheapest hedge. It is really a way to avoid being a forced seller in a bad market. You don't need privates and alternatives to do that. And to your point, I think the reason why everyone's hearing about them now is because they're being marketed. They're going into 401k plans. They're going into fund vehicles where you don't have to necessarily have, a certain amount of wealth of maybe 5 million or more to access these. They're trying to, democratize finance. And I hate that word because not everyone needs exposure to everything.
No, they're not trying to democratize finance. They're trying to prop up their earnings because the institutional markets aren't interested in this anymore.
Correct. And
interest rates, all the other things that get put into that, But
correct. And they're going to go door to door just like you used to.
Yeah.
They're going to pick up the phones. It's a little bit of people are being sold on them right now. And that's never a good reason to make an investment decision is because someone had to sell you on doing it.
Right. But I'm going to say this too, that opinions are not either right or wrong, right? There are a lot of versions of being right in this industry. Okay. Fortunately for investors, there are not a lot of opinions that are wrong in this industry, right? They're just varying degrees of being right. And I go back to my comment about the statistics of just staying invested, right? So you could have conversations about diversification. You could have conversations about how, it treats volatility, if that's a symptom. There are different versions of being right. So just because my philosophical perspective on this is one thing does not mean that I think everyone else is wrong or that I think anyone who has private equity is not doing the right thing. That's not what I'm saying at all. I'm just saying philosophically, I don't see a whole lot of reason for the average Mr. and Mrs. Smith investor who has been accumulating wealth through whether it's through disciplined savings or selling a business or inheriting or executive compensation that generates the kind of wealth of our client base that we work with. I'm just saying, I don't think you need it. It's not that if you add it, you're making a massive mistake. I just question the value proposition of the alternative investment space. And I will tell anybody listening who is invested in alternative is going to nod their head up and down because they're going to have experiences too. I'm going to say it's people who aren't invested in alternative investments that they need to brace themselves for this. If you ask me how well I'm doing in my private investment, my answer is, I don't effing know. I have no idea for 7 years. I have no idea. And I'm getting 20% of my original invested capital back. To me, I think that is one of the toughest things, and one of the things that drives my opinion and perspective and philosophy on alternative investments is like, you're going to get involved in something that for 7 or 8 or maybe 9 years, you have no idea what your return actually looks like. And you're getting all these massive K1s and all this other crazy stuff that like messes up your taxes and everything else.
Yep.
Yeah. I just question the value proposition. And again, I want to really be clear here that I'm not saying it's wrong, and I'm not saying people shouldn't do it. I'm just saying, you probably don't need it. And I would argue the value proposition.
Yeah. Again, I think it comes down to a very specific situation, just like everything in life. It's not as broad-based as that. It's a very specific investment for a specific need. But
yeah, exactly.
Well, we went a little long today, Dave, but I love
Dude,
it.
I love talking about this stuff, you know?
I know.
So it's easy. It's easy for me.
It is. But that covers, again, another AMA segment that we have here on Monument, and we do these every month. So if you want your questions answered, leave us a comment anywhere that you see this video. We're always looking at those, or send us an email, off the wall, all one word, at monumentwm.com. So we always love the questions. They inform what we talk about, but thanks everyone for tuning in. Make sure to hit the subscribe button so you never miss an episode, and we'll see you next time.
Yep. See you in August.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.